Most people think the IRS sees everything, and in some ways, they are right. But there is a category of information, completely legal, fully protected under federal law, that the IRS cannot touch, cannot demand, and in some cases, cannot even ask about. I spent years inside that system. I know exactly where the walls are, and today I am going to show you 3 things you should be keeping on the other side of them. This is not about hiding income. This is not about cheating. Every single thing I am going to walk you through today is protected by a specific provision of federal law. The people who use these protections are not criminals. They are the people who took the time to understand how the system actually works and positioned themselves accordingly. The people who don't know about them are paying for that ignorance every single year. Thing number 1, your Roth IRA. If you have a Roth IRA and you are taking qualified distributions, meaning you are over 59.5 and the account has been open for at least 5 years, those withdrawals do not appear anywhere on your federal tax return as taxable income. They are invisible to the IRS for tax purposes, not deferred, not reduced. Gone. Here is why that matters more than most people realize. The IRS calculates something called provisional income to determine how much of your Social Security benefit is subject to federal tax. That formula takes your adjusted gross income, adds non-taxable interest, and adds half of your annual Social Security benefit. If that number crosses $34,000 as a single filer or $44,000 as a married couple, up to 85% of your Social Security benefit becomes taxable. A traditional IRA distribution counts toward that number in full. Every dollar you pull from a traditional IRA pushes your provisional income higher and can pull more of your Social Security into the taxable column. A Roth distribution does not. It does not appear in adjusted gross income. It does not move the needle on your provisional income calculation. You take the money, you spend the money, the IRS does not see it as income, because under the tax code, it is not. A retiree pulling $40,000 a year from a traditional IRA could be paying federal tax on up to 85% of their Social Security benefit. The same retiree pulling the same $40,000 from a Roth could owe nothing on that Social Security income at all. Same amount of money, same lifestyle, completely different tax result, because one of them understood where the wall was and built their assets on the right side of it. If you have not yet converted a portion of your traditional IRA to a Roth, the window to do it at favorable rates may be shorter than you think. Tax rates are set to reset in 2026 when provisions from the Tax Cuts and Jobs Act expire. The lower the rate you pay on conversion, the more powerful the protection becomes on the other side. Thing number 2, your primary residence. When you sell your home, the IRS allows a single filer to exclude up to $250,000 in capital gains from federal taxation. A married couple filing jointly can exclude up to $500,000. This exclusion lives under Section 121 of the Internal Revenue Code and has been in place since 1997. Here is what most people do not understand about it. You do not have to be selling your forever home. You do not have to be downsizing in retirement. The requirement is that you have lived in the property as your primary residence for at least 2 of the last 5 years. That is it. 2 years of occupancy in the last 5. You do not have to have owned it for 20 years. You do not have to have purchased it at a particular price. 2 years. For a retiree who bought a home in 2018 for $280,000 and is selling it today for $550,000, that is $270,000 in gain. Under Section 121, the first $250,000 of that gain is completely excluded from federal taxation. The remaining $20,000 is taxed at long-term capital gains rates, 0, 15, or 20% depending on your income, not at ordinary income rates. The effective tax bill on a $270,000 gain could be as low as $0 if the total gain falls within the exclusion. The IRS does not advertise this. The form you file when you sell your home does not come with a note that says, by the way, most of your gain is excluded. You have to know to apply the exclusion. And millions of homeowners who sell every year either don't know it exists or don't know how to claim it correctly, and they pay tax on gains they were never legally required to pay. One additional layer. If you have made capital improvements to your home over the years, a new roof, an addition, a kitchen remodel, a new HVAC system, those improvements add to your cost basis and reduce the size of your taxable gain. Every dollar of documented improvement is a dollar the IRS cannot tax. Keep your receipts. Keep your contractor invoices. Keep your permit records. They are worth real money when you sell. Thing number 3, your life insurance cash value. This one is the most overlooked financial protection in the tax code, and the one I watch the most people walk past without ever knowing it was there. Permanent life insurance policies, whole life, and certain universal life policies accumulate cash value over time. That cash value grows tax deferred inside the policy, and when you access it through a policy loan rather than a withdrawal, you pay no income tax on it. None. A policy loan is not income under the Internal Revenue Code. It does not appear on your tax return. It does not affect your provisional income. It does not push your Social Security into the taxable column. It does not trigger the net investment income tax. It is, for tax purposes, invisible. The wealthy have known this for a long time. A business owner who builds significant cash value inside a permanent life policy over 20 or 30 years can access hundreds of thousands of dollars in retirement. tax-free, without touching their provisional income threshold, without triggering IRMAA surcharges on their Medicare premium, without affecting their Social Security taxation. The policy loan mechanism under Section 7702 of the Internal Revenue Code is one of the cleanest and most underused protections available to American taxpayers. The caveat I want to be clear about: this strategy only works correctly when the policy is properly structured from the beginning. An overfunded policy that crosses what the IRS calls the Modified Endowment Contract Threshold, the MEC line, loses most of its tax advantages. If your policy becomes a MEC, loans and withdrawals are taxed as ordinary income. The structure has to be right from day one. If you are considering this and you already have an existing policy, have a licensed professional review the MEC status before you do anything with it. Let me bring all three of these together for a moment, because the real power here is not in any one of them. It is in the combination. A retiree with a properly funded Roth IRA, a primary residence with significant equity, and a permanent life insurance policy with clean cash value has built something the IRS genuinely cannot penetrate. Their retirement income can flow from three sources, none of which generates taxable income under federal law. Their Social Security benefit stays below the provisional income threshold. Their Medicare premium is not inflated by IRMAA surcharges. Their estate passes to their heirs with stepped-up basis on assets that were never taxed going in. That is not a tax shelter. That is the tax code, used exactly as Congress wrote it. The people in the highest tax brackets in this country are not paying the most because they earn the most. They are paying the most because they do not know where the walls are. The people paying the least, legally, are the ones who built their financial lives on the right side of those walls before the IRS ever came looking. You still have time to reposition, but the window does not stay open indefinitely. Drop a comment and tell me which of these three you already have in place and which one you had never heard of before today. I read every single one, and what comes up most in the comments is always what I cover next.